Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, February 21st, 5:01 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we've added short-term caution to the uptrend as all five of the major indexes had a clear break and closed below the 21-day moving average today. Bears very clearly won the day today after the Bulls undercut, reclaimed the 21 on Friday, gap down and a clear break today, unfortunately, for the Bulls. Check over here in the trend gauge. I still have a bunch of leaders holding up fine. Now, between my 21 over 21 list and my universe list is 37 stocks. Only one of them, and it was an ETF, the XBI Biotech ETF. Only one of them clearly broke below, actually, two of them. Boeing clearly broke below the 21 also. There were a couple that are a tenth or 1 or 2 tenths of a % below. The others holding up fine. So the indexes are looking worse than leading stocks are. Uh, we split our portfolio, as you know, in-house between the market indexes and leading stocks, and we're now overweight leading stocks versus how much we have allocated to the indexes based on Friday's weakening and today's close below the 21. That's why you'll see short term. We're still showing uptrend because we require two closes below the 21 to get off of bullish, but the yellow arrow here, we get a second close below, will very clearly come off of there. Medium term, two closes below the 50-day for the Dow now. The rest of the indexes are still above the 50-day, but coming up close to it. 200-day moving average, we saw some glimmers of hope last week leading into Wednesday that the slopes of the lines of the major indexes would start going from down to flat to up, but any attempt at them going higher has been squashed over the last three sessions. Mid caps still holding on, so we're neutral there. And of course, we break below the 200-day moving average. You know our thoughts on that. That's where all bear markets occur. This may be another leg down. If we break below there, we'll get defensive. Until then, we'll continue to uh, keep some exposure on at a minimum of 0.6 beta, since we're still above the 50-day moving average. We'll take a look at what we did in-house and how we're exposed today when we go through the tail of the tape and the charts. Here are the numbers, and they're not pretty. G6 down 3.14%, S&P gap down 9/10, finished down a full 2%. NASDAQ 100 down 2.4. Couldn't hide in the Dow today, down 2.1. Mid caps down 2.4. Russell down 3%. Global diversified 60/40 stock and bond down 1.36. In-house GROTECTION down 1.57. Some of the stocks we hold held up better than the index. The hedges that we had, TBT up 4%. We added SARK as a hedge that was up nicely on the day. Don't like the final. It's never about one day. I don't like being down 1.57%. It's certainly better than being down what the S&P is, and I'll explain why we've gone recently into a new version, not a new version, a new expectation level, and it's a lower expectation level after we get through the major index charts, and then we'll show charts of interest. So let's get right into it. And we'll start with the 50-day moving average. We had been above for over 20 days above the 21. We undercut and held it at the end of the day on Friday. Clear break below today. You can see on the 5-minute chart. Here is the rally into the close that got us back above, gap down, and just trend down all day. Lower highs, lower lows all day. 39.95. Well, okay, an inverted cup over the last 2 hours, but still no strength whatsoever. Let's go to a 60-minute chart. And here's the 4,000 level that we're sitting on right now. The next level down, there's a lot of support right below here, namely the 50-day moving average, the 200-day moving average. And if we just hold here and undercut and reclaim tomorrow, there's two major fibs at 39.99 and 4,007. But very clearly not the day that the bulls were looking for. We're very oversold on the 60-minute stochastic. But the bears didn't care. They kept growling and clawing away all day long today. Here's the NASDAQ 100. This had been holding up. It bounced at the 21, holding up better than the S&P, gave way today. The negative stochastics continue to get worse as they head down toward oversold. Broke the 300 level. On the S&P, let's bring this back up. The S&P, you've got the 50-day above the 200-day, so we're another 0.5% down to the 50-day and a 1.4% below the 200-day. We're 3 days down now. Usually on third day down, you don't want to continue selling or trimming. That's the time you would start looking for a counter trend bounce. The question is that bounce going to be strong enough to get back into the declining moving averages now? The 21's declining. The 8's going to come through the 21 tomorrow. Realistically, and if we're trying to be optimistic, we're right on the edge of these three levels that I talked about this week. The first level being the base in December, the second level being trying to move up above that level in January, the third level where we broke out late January and February, but we're sitting right back down on that now. And the 50-day moving average is basically the dividing line between that and the second level, and then a break of 3,900 to get us down into this level. That'll put us below the 200-day moving average. Very clearly not good for the bulls. Here's the Dow Jones Industrial Average showing relative strength, but just going sideways. And then today down 2.1%, the hard break, two closes below, no, one close below the 50-day. We had that rally back above the 50 and into the 200 today, but this maybe was a precursor. The fact that the slope of the line of the 50-day started rolling over before we broke it. That's not a good sign. You don't want to see that. Here's the mid caps. The 50-day still pointing higher on the mid cap index, but again, we bounced at the 21 last week. We broke below it today. That's a negative change in character. IWM, we bounced at the 21 last week. We broke below it today. Another negative change in character. The equal weight indexes were down. The QQEW down 2.4, so basically in line with the NASDAQ 100. Equal weight S&P down 2.17, worse than the market cap weighted S&P. So there was no place to hide in saying that, hey, the equally weighted wind indexes, they didn't hold up either. Additionally, the VIX had a big spike up, clearing all of this consolidation that it had over the prior 3 weeks, now above the 21, above the 50-day. The inverse correlation between the VIX and the market very much intact today. After last week, 3 attempts at getting above the 50 and failing and closing at the low of the day, where the market itself, in some cases, did not close at the high of the day. That was a positive divergence, but that divergence gone now. Seeing what the VIX did. UUP, let's look at a 5-minute chart of this, because intraday we gapped up and then we quickly sold off. But this sell-off here did not correspond with a sustained move up in stocks. Like we saw here on Friday, and then all of the strength in the dollar regained into the close, and the strength of the dollar corresponded with weakness in the market. Check the daily on the dollar. You can see it's been 4 days above the ADMA now, the 21 crossing through the 50, changing the trend. It is overbought. We can stay overbought. You can see on here as much as 4+ weeks. This is our second week of the dollar being overbought, corresponding with the move down in the S&P, which really started in the last hour of a close last week when Fed head Bullard started talking about higher for longer. Let's switch to bonds now. Bond prices down. Look at these. Just continuing to be a frozen slope lower on bond prices, very oversold. But again, we can stay oversold for weeks at a time. You can see 5 weeks here, 2 weeks here, 4 weeks here. This is the beginning of the third week. that were oversold on bonds. And if the prices were down, then yields were up. Let's go to corporates first. LQD down 1.4%, even worse than the broad index. Junk bonds, even in line with stocks, down 1.58%. That's not looking good either. TLT, the 30-year, down 1.94%. Let's go to the 30-year yield, making higher highs, just a beeline higher, riding that ADMA higher. It is, again, getting into oversold. But as we said, we can stay oversold. Serious relative strength on the yield. Let's go to the 10-year TNX. TNX with a gap up 3.3% today. So yields clearly higher. Let's switch to gold and silver. We'll go with GLD, only down 0.37% today, so not making lower lows. This is consolidating over the last 4 days, very similar to the way the dollar is consolidating. It is very oversold. Also, GDX, gold stocks, making a lower closing low, sitting right on the 200-day moving average. Silver was positive today. Yeah, it was positive. Into the ADMA, that's a counter trend rally, showing some relative strength over the last week, though. Bitcoin, the ITO, down 1.7% today, consolidating the gains that it's put up recently. So there are the major indexes that we follow. Let's go to the tail of the tape. And the important things to point out here is that the first domino in the bear case fell with a break below the 21 today. Some news, and this didn't help the market at all. PMI data strong, the first expansion in 8 months. If the economy is expanding, interest rates are not going to, the Fed's not going to stop cutting interest rates. The dollar's not going to chill. And that's a negative for stocks. Day count from 2 down to 3 down, 3 days below the ADMA, first day below the 21 EMA, still 31 days since the follow through day. We got FOMC minutes tomorrow afternoon. Expectation neutral as long as we held 40-50, but we broke it very clearly and also added 4,000 to the break, the 50-day moving average, the next support. Trend down, lower lows, lower highs all day. Just bond yields and the dollar stronger. 11 out of 11 indexes down. XLP, the ultimate defensive sectors, consumer staples, the only was significant, showed relative, it was down, but it showed relative strength. Here's the focus list. We'll hit some of these charts here. What did we do in-house? Trimmed our index long, trimmed GFS, not acting well, trimmed a little bit of AB and B, the last buy that we did, and added SARK, that's the inverse ARK-K, and 1% in Iridium, which, as I pointed out on Friday, had the very rare day 2 higher high in volume. It held up very well today, volume just above average on that. Bottom line, clear break below the 21. The 50-day is a 0.5% down. The 200-day is 1.4% down. Those are the next levels. Let's take a look at some charts. We'll start off with what we bought today, and we'll start off with Iridium, IRDM. So here's the gap up. Actually, it was a shakeout and a bounce off the 50-day moving average on earnings. They announced a big Qualcomm partnership back here on 1/6. That was what was responsible for the initial breakout. But trickle little by little, the market was saying, prove it to me. What do you really have? Gave all of it back into the 50-day. Then the last 2 days, big volume, up big today, barely above average volume on the pullback. Volume, there was some volume that came in near the close, and it actually was trending higher into the close while the markets were coming off. If the market rights itself, I would expect this to be a strong leader. The other one that we added was SARK. This is inverse Cathie Wood, as it got above the ADMA because ARK-K broke the ADMA and the 21. So this is another one that we're just going to kind of ride the trend lower, very similar to the way we've been riding the TBT trend higher along the ADMA. Those have been acting as hedges for the overall portfolio. What we trimmed today, GFS, sold 2/3 of it. Broke the 8 gap down, broke below the 21. We have a very small. This is a failed breakout, basically, out of a nice cup base with an earnings gap higher. And Airbnb, we trimmed our last buy on this. This is holding up okay. Volume below average today. It's holding above the 80 MA. Traded in a much tighter range today relative to the 3 days where it gapped up in the 2 days following the gap up. Let's take a look at a couple of other charts. Boeing, we're down to 3% size in this. That's sufficient because of how defensive the stock is. It's going to be its first visit to the 50-day moving average. We sold, this was up to an 8% position. We sold it down to 6, then we sold it down to 3, went to 3% when it broke the 21. Note it's the first visit to the 50-day moving average. That's an O'Neill add or buy point, provided the market um, provides support. We don't know for sure that it will, as you are very clearly know what the market's been doing over the last several sessions. So we'll see what happens to Boeing when it comes into the 50-day moving average. And I think that's going to wrap it. We've got some other things not quite approaching their stops. We took our risk down from 1.13 to 0.93. Break of the 50-day will get it closer to 0.6. We've got levels of exposure that we want to have depending on where the overall markets are and depending on how leading stocks are. As I mentioned, only 5 of the 36 that are on my leaders list, the 2121 leaders list and the universe list. The worst of them today was biotech. This looked really good with this setup. Oversold, stochastic cross, but right into the 21. I wanted to wait until it cleared the 21. Considered buying it last week, didn't buy it toward the close, and good thing, down 4.64% today. Rising interest rates are not good for growth stocks. Biotechs are about the ultimate growth stocks. So why do we do what we do here at Revere? We protect the downside. Nobody wants to see 30, 40, 50% losses in a bear market. Our losses last year were half of what the market maximum market loss was down, down slightly year to date, but no severe losses. We know all of these occur below the 200-day moving average. We're still above the 200-day moving average, been back above it for a couple of weeks here. If that gives way again, we'll switch back to maximum defensiveness. But for now, we're holding on, give the market the benefit of the doubt after 3 days down now. Possible scenario for an oversold rally. And what I wanted to mention with the change in market conditions. So bear market rally, this is what happens off the bottom. Very typical for as we go from very minuscule exposure under the 200-day moving average to the market starting to come off. It's normal that we have moderate underperformance. We get back above the 21, above the 50. That's early bull market or a bear market rally. It's looking like it may just be a bear market rally. We either have inline or minor outperformance. In this case, it was inline. Now with the pullback, more than 4% off the highs, also 3 ATR off the highs in the S&P. We're in the expectation area of a bull pullback where we should see inline performance or minor underperformance. We've got below 1.0 on our beta now, so we shouldn't see any underperformance unless we would get a big gap down or something, or we would get a massive move back up in the market and we would be caught closer to down, being down 6 to having beta less than the 0.9 that we have now. But so a shift from bear market rally, early recovery to bear market rally, now to bull market, mild pullback, more than 4%, and also 3 ATR off the high, the next level down. We would be all out before we got to this mild correction level because that's 8% off the highs, and that's also below, significantly below where the 200-day moving average is. So those are the expectations for where we are in the current market conditions. And that's going to wrap it. You have any questions? Email me, don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. You can also email my partner, Dan Stewart, dan@revereasset.com. We've had a lot of people contacting us with the weakness in the market lately. Maybe understanding that what we've said, you've got a reprieve, you've got a market rally off the bottom. Is it going to go into another leg down because of the recession and the Fed's inability to get inflation under control? Or are we going to hold, go sideways, and look for some economic data that's more favorable to what the Fed is looking for? We don't know. We do know that we've got our stops in place and we've got a plan. Uh, we discuss the leading stocks all the time. There was 21 of them that we went over on Friday. Maybe I'll go over the other 16 tomorrow. XBI was the one ETF that was in there that had a promising setup, but it broke down. But remember, it's not how much you make in the markets, it's how much of that you can keep. And with that, I'll wrap up Monday, February 21st. This is Don Vandenbord telling it like it is. Facts aren't always good, but they are the facts. Thanks for listening and have a great day.